Yeah, hi traders. So we're coming into the meat of the week, and of course the major event risk that traders will need to navigate their portfolios and their exposures across, and that being the US CPI print and the Fed meeting, which comes out 5.5 hours after that point, and then half an hour after that, the statement drops. Of course, Jerome Powell steps up to the press conference where he was grilled on a number of factors playing through. Of course, we're coming off the back of a very, very strong non-farm payrolls number where the establishment survey came out at 272,000. That was obviously a 4 standard deviation beat to consensus. Of course, the household survey going the opposite direction, but the market was very sensitive to what we saw in the establishment survey, and obviously that you see that with the 16 basis point increase on Friday in 2-year Treasury yields. Now, with that in mind, we are going to be watching the CPI print very, very closely indeed. And if we have a look at expectations in the market, the central case is that we're going to see headline inflation coming out at 0.1% increase month on month, and that equates to a 3.4% year-on-year clip. On the core number, which I think is where we're going to devise our playbook for markets, the market's expecting 0.3% month on month, and that equates to 3.5% year-on-year clip. Now, the way I'm thinking about this is obviously on a 2 decimal point basis. I think anything that rounds down to 0.2%, i.e. below 0.25%, or below, certainly you could see front-end yields moving a little bit lower. The US dollar could come under a bit of pressure. And you could see a bit of relief playing through in equity markets, new highs playing through in the Nasdaq, for example, and potentially some upside in gold, given what we're potentially going to see in the yield market. On the other side, anything that rounds up to 0.4%, i.e. above 0.35%, or above, you could see the US dollar having a bit of rally, front-end yields will make a move higher, and you could see equity markets coming under a little bit of pressure. I think where you see real venom coming through in financial markets, if we were seeing an absolute print below 0.2% or above 0.4% on that month core print, then I think, you could see some fireworks playing through. Obviously, we're going to have a look at the rates pricing. I think this is where we start. If we have a look at swaps pricing at the moment, you're not really seeing anything priced out until September. And then there's about 13 basis points of cuts being priced for that meeting. So that's about a 50-50 chance of a rate cut by September. So obviously, people will be massaging expectations based on what we've seen from the CPI print around that. And obviously, if we just see 0.4% or around that figure, rate cuts could come out. The market could be pricing less than 10 basis points. And certainly the market will say there's a greater chance that the Fed are going to be on hold now till the back end of the year. Obviously, if we'd see 0.2%, then that chance of a September cut, even though it is the final meeting before the presidential elections, that would become the market's firm base case that we get a rate cut playing through. Now, of course, we go into the CPI print, we will be looking at the subcomponents as well. Core services is expected to drop a little bit from the current rate of 0.41% month on month, and that's expected to drop down to about 0.38%. We're going to be looking at owners equivalent rents and those factors as well. If we have a look at core goods, that's expected to show continued deflation, but probably at a slower pace at the moment. And then we go into the super core number, which is expected to drop a little bit from the current pace of 0.41%. Now, the Fed will be looking at that very closely indeed. But I think, certainly the components will be something that the analysts look at very closely. Now, we go into the Fed meeting. Where are the risks? Are we expected to see more of a hawkish tilt or more of a dovish tilt? Well, I'd probably say on balance, there's probably more hawkish risks to the Fed meeting. Obviously, we'd see what happens up post the CPI print. That could be the influencing factor. But I think the first thing is when the statement drops, the statement should continue to read that the Fed have got further patience, that they're very much in a restrictive territory, and that restrictive territory gives them confidence that inflation will fall down to target over time. But time is what they want, and they need to see further confidence that inflation is coming down to target before they look to cut rates playing through. So I don't think that changes too much. We're going to look at the statement of economic projections. And if we have a look at growth, we're expecting growth to drop from about 2.1% from this year down to about 1.7, 1.8%. The unemployment rate is expected to tick up a little bit from current projections of 4% for this year to about 4.1%. The remaining years are probably going to be unchanged. And if we have a look at the dot plot projection as well, then there's a good chance that we're going to see the current target of about 4.6%, which implies 3 rate cuts this year, dropping to or moving to about 4.9%. So the central tendency from the committee is that we get about 2 rate cuts playing through. Now, there is a small chance that we could get 1 rate cut being priced in terms of the central tendency, but it's a very, very small chance indeed. And going out to the final years for the years ahead, we're not expecting any changes to their projections, to Fed funds projections there. Now, the long run Fed dot at the moment is at 2.6%. There is a chance that goes up to about 2.7%. The market obviously is positioned firmly further ahead. They do see the neutral rates, the position where the Fed rate is no longer restrictive nor stimulatory, around sort of 3.8%. So obviously the Fed's neutral rate could matter to markets. But we are expecting the Fed dots to move up a little bit to show two hikes. Two cuts playing through. Now, obviously, the distribution of those dots could be very interesting indeed. And also, we expect core PCE, I think this is important, to move up from around 2.6% for this year to around 2.8%. So the higher that goes over 2.8%, you could see the bigger reaction playing through markets. Now, of course, Powell will be grilled shortly afterwards, and that could cause some fireworks playing through. We'll have to see. But at the moment, we're looking at a dollar index, which is going to be following two-year Treasury yields and rates pricing as well. Could we see the two-year push up into that sort of 5% level, the top end of the range? Conversely, we've got the bottom end of the range around sort of 4.7%. So the dollar index is going to be firmly followed around that. And obviously, a close above 105.20 could be quite positive for the bulls. We've got our eyes on dollar yen as well. If we make a move above that recent pivot high around 157.71, that could bring the Bank of Japan Ministry of Finance back into play. We're getting closer towards those intervention levels. Obviously, something we're watching as well. And obviously, we've got gold as well, trading in this kind of 23, 25, 22, 28, 22, 85 range as well. Something we're watching. So a big one ahead. We're going to be watching that core month-for-month clip in terms of the potential for impacts on rates market as well.